Again, I'm a macro guy, so I don't have the engineering background that Lynn has, but how I approach this is I look at the attributes of how it trades as an asset. And what I did is I looked at estimations of network effects and said, well, do they look similar? And when you plot out Bitcoin's journey, its market cap or its price versus the number of active wallets, actually there's a nice clear regression line. And it happens after a certain period of time. So it gets to about 5 million wallets, and then it goes in a very clear, steep line, which is essentially an estimation of Metcalfe's law. And I found that Ethereum was exactly mirroring Bitcoin. When I say exactly, when I look at it on a plot graph with the same regression, it looks similar, but because it started later, it just follows Bitcoin earlier. But in fact, its adoption, i.e. the number of wallets at this time, is actually a faster rate of adoption than Bitcoin had. But what's super interesting is when you go back and match them from 1 million active wallet addresses each, their prices are identical and their price movements have been identical. And that took me by surprise. I didn't expect to see that because that normally doesn't happen. You have to fit the graphs, but it perfectly fit in every way. It's exactly currently in the 2017 run-up that Bitcoin had. And at exactly the same time, after it hit 1 million wallets, it gives you something similar. So that's when I say ETH equals Bitcoin, is because when you think of it in macro terms, they're both really network effects. And so they may have very different properties. There may be different things entirely. And people struggle with value when it comes to network effects. Almost everybody underestimates value by definition, because we try and anchor it on something that we perceive as value. But network effects are so hard to think in because they're exponential.
Yeah, this is really interesting. And you're right when I think to the kind of like late 2013, early 2014 run up in Bitcoin. I think it peaked at about 1250, and then ETH in the last cycle peaked at about 14 something 20 or roughly, so just 200 or less than $200 difference.
And they both had 90% pullbacks. Everybody said they were dead, they were worthless. Bitcoin got down to about 100 and started rallying. ETH got down to 100, it's literally identical. And that's weird. That's weird.
Raoul, does that mean that you allocated 10 or 20%?
So I started at 80-20. The Ethereum's gone up a lot more already. And then I allocated more. So I'm like 60-35. And then I went further out the risk curve and I bought a basket of alts as well. Equally weighted.
Which ones?
Well, I'm not going to say because because I don't want to make it like I'm pumping anything, because the alts world is a little bit wild and crazy. So I didn't want to do that. But basically what I took was, I just looked at ones that looked like they were getting network effects. I asked people on Twitter, I got 6,500 responses. So I could figure out, okay, what looks like they've got network effect here. I look at the charts, and as long as they're a reasonable size market cap, I just took an equally weighted basket because I've no clue and I just don't have time to understand these in the depth that, we've all had to learn Bitcoin in, and we're all having to get up to speed with Ethereum in. So I did that because I know in the end, everybody does what I've done, which is they go further out the risk curve. They do it in emerging markets. So you might start with the EM ETF, which is a very simple way of getting emerging market exposure. Then you might get more India exposure because you kind of favor that and it works for your time preference. Think, okay, India, I can see that this is going to work for the next 10 years. And then as that trend starts developing, you start buying all sorts of frontier markets because everybody's piling in the risk curve. And the same happens in crypto.
And so you don't even know if they were like DeFi tokens.
I've got a mix from derivatives to DeFi to DEX. I purposely made a kind of relatively balanced basket. It wasn't a totally random process, but it was just some of that, to try and get an overall balance of the space. I wanted interoperability, I wanted DeFi, I wanted fast payment networks. I wanted, just different things, different protocols that allow smart contracts, and just got an overall basket of that. I think one of the things we're talking about here, and again, I wrote in that long article that I wrote in Global Macro Investor about this, is S curves are very prevalent in this. And the S curve is, it's either the questioning point or the failure point. And what we're saying here is there's a big S curve in Ethereum right now coming up. And will it work or will it not work? We don't know. Almost all of the currencies have had this. Bitcoin's had several S curve moments where it could have failed and it didn't. So then the Lindy effect takes place, which is the longer it survives, the more likely it's to survive. So again, it's why we're all really interested in this space, because there are outcomes of which we don't know. We can't figure out the probabilities. We've got no historical parallels. So it's a really interesting space for all of us to try and figure this out, because what S curve is just a pause before the rise. And maybe that's what I think Ethereum is going through. Again, I don't know, we'll find out. And that drives us further up Metcalfe's law and the Lindy effect. Some of these S curves will see total failures. So as they have existential crisis. So it's amazingly interesting.
You did tweet that you thought ETH might well, and I'm quoting here, might well go to $20,000 this cycle. Are you still standing by that?
It's all I did, no magic. I took the chart from 1 million wallets and 1 million wallets in Bitcoin. And where did it go? It went to 20,000. So I'm like, okay, that's a good enough guess. Does it hit that? Does it not hit that? Irrelevant. What it means, what I'm really trying to say in something like that is it's much larger than you think. And we've got some idea of an event that played out in the past that looks very like this. And, people like me love a bit of a historical chart pattern, even though I said this whole new space exciting. But when you've got something that's so highly correlated, it's like, okay, this is interesting. That sounds a sensible target. And I know it sounds nonsensical to many, but because nobody can think in exponential terms. We're just incapable as humans.
It's like a lack of visibility. So in that sense, the fact that blockchains can make the data transparent is actually literally pretty much the major advantage.
Trusted ownership. It's the basic essence of the blockchain is a verified trusted ownership structure. That's what it gives. And we don't have that in the securities market at all. You don't have it as a brokerage customer. You don't have it as a brokerage house. You don't have it as a clearing entity. You don't have it as a custody entity. You don't have it as a bank. Nobody has trusted ownership of anything, which is why people store gold in a gold vault. And you have to make sure that the paperwork says that they cannot reuse it, because you can put it in a gold vault and they can still reuse it.